Welcome to Beavers Wealth Management's May 2024 edition of Let's Talk Markets. And you may notice we're actually doing our first Let's Talk Markets from our new office in our new podcast room. We're incredibly excited about some of the advancements that we're bringing to you today, and more excited about the content we're going to share. So, as you know, it's our goal to continue to grow Let's Talk Markets with the intent of educating and empowering the families and businesses we serve. So if you know of anyone who may find this information valuable, please feel free to share it with them. So as I said, we've got a great show for everyone that's joined us today. And as we typically do, this edition is going to focus on three key points. First of all, a quick glance to the past. What's happened in the market this past May? Second, we're going to take a hard look to the present. A discussion on the recently proposed changes to the tax code and capital gains taxes. And then as always, we're going to look to the future. We're going to talk a little bit about investing in AI and what factors are at play in determining which companies will come out on top. So as we typically do, and I'm not going to spend a lot of time on this, but I'd like to go over a few key data points as it relates to the market over the course of this past month. And so as you can see, the S&P 500, we've had a really good year. Actually, some of the numbers show the year-to-date return on the S&P 500 closing in over double digits, almost 12%, whereas the Dow Jones right at 4%. What's interesting to me is that if you look at every sector out there in the market, every sector is positive except for one, real estate. Real estate's down about 6%, and we've talked a little bit about why that's the fact, because of interest rates being so high. Unemployment rate still around 3.9%, so under 4%, which is solid, and GDP at 1.6%. Now, as we have begun to do, I'd like to share this month's of Ryan's market fact. And so we introduced this market fact in the Ryan Market Points last year, or last Let's Talk Markets, and this one's very interesting. So May has been an exceptional month for the markets. And this month, we've actually seen the Dow Jones Industrial Average briefly set a new record above 40,000. The Nasdaq is reaching all-time highs nearing 17,000. And the S&P 500, it actually set a new record above 5,300. So what can history actually teach us about markets setting record highs? Well, if you take a look, the current year performance of this year, the S&P 500, actually, it's made its 23rd all-time high, and you know, we're not even halfway through the year. 23rd all-time this year. Let me give you some historical context when it comes to that. Over the past 12 years, the S&P 500, I thought this was very interesting, has hit 370 all-time highs, and that's more than any other 12-year period in history. Since 1950, there have been more than 1,250 record highs for the S&P 500. That averages out about 16 per year. What did I say? We're already at 23 for the year 2024? It's pretty interesting. A couple noteworthy years. The record for the most all-time highs in a single year is actually 77. Whew, we got a long way to go. In 1995 that happened. And it was actually followed by 70 in 2021, just a few years ago. But here's what's most interesting. The average return in years since 1950 that have had 16 or more all-time highs, so like I said, we've already had over 20 this year, the average rate of return, 21.54%. It's a pretty good omen for what we might experience this year. Let's hope it stays to the trend. Okay, that's Ryan's market fact for May. But now let's talk a little bit more about what's been going on here in the markets. Obviously, the thing that we wanted to talk about, Nvidia's latest earnings. I know a few of you clients have actually been on each of the Nvidia earnings calls because that's how excited people are about the stock. So of course we had to mention the earnings because of the influence this performance has had on markets right now. So this AI-fueled stock has propelled the markets to historic highs. So much, in fact, that each of the company's earnings have been considered a make or break moment for market momentum. And we've talked about this, right, before on previous Let's Talk Markets. Due to their outsized market capitalizations, the Magnificent Seven, which are Apple, Microsoft, Google, Nvidia, Amazon, Meta, and Tesla, they hold a disproportionate influence on the market cap weighted indexes like the Nasdaq and the S&P 500. So what actually happened in the earnings report last week? Well, Nvidia reported fiscal first quarter earnings last Wednesday that beat market expectations for sales and earnings. And as our chart shows here, this immense success is largely built on one pillar of the company. So what is this pillar? This pillar is the data center segment, which includes their chips manufactured specifically for the AI industry. So I want you to think of cloud computing and high-powered server farms. So I wanted to read a quote here that the CEO of Nvidia, Jensen Huang, talked a little bit about. And what he said is, the next industrial revolution has begun. Companies and countries are partnering with Nvidia to shift the trillion-dollar traditional data centers to accelerated computing and are building a new type of data center. You know what this data center is? It's AI factories to produce a new commodity, artificial intelligence. He continues to say AI will bring significant productivity gains to nearly every industry. That's what we've been talking about, and help companies be more cost and energy efficient while expanding revenue opportunities. Close quote. Now, we'll get more into the ideas of how you should think about investing in the commodity of AI later in Let's Talk Markets. But last but not least, I don't know if you heard about the banker who broke up with his girlfriend. He said he just lost interest. All right, first dad joke of our new Let's Talk Markets. Let's talk about the current present day item that we want to discuss. So we talked a little bit about the past. What about the present? We're going to talk about some of the proposed tax changes. And just like everybody else, I saw the headlines about a brand new 44.6% capital gains tax rate. I'm like, whoa. Also expiring middle class tax cuts, and the highest tax rate for many in a century under Biden's latest proposal. So we looked deep into the proposal, right? And just as I expected, there's a lot being left out and misinformation being spread around as fact. And so what we really wanted to do today is we wanted to talk about the truth and how this pertains to you. So keep watching if you really want to find out what's going on. And chances are, if you make any amount of money and you live in the United States, this is going to affect you in one way or another. So this is worth breaking down to learn how this is going to impact you. Now, I understand this tends to be a politically charged topic, and I want to make this very clear. I don't get into politics. I don't pick sides. I just stick with the facts of what's in front of us, and that's it. And so what we're going to talk about today are the proposed capital gains tax changes. So first of all, capital gains tax rate increase. This new proposal would tax long-term capital gains at ordinary income tax rates. So what does this mean exactly? This means a 39.6% tax on incomes over $1 million, plus a 5% net investment tax on incomes over $1 million. So that brings the total long-term capital gain tax rate to 44.6%. That's up from the 23.8% that it currently is. That's a big jump. All right, second of all, short-term capital gains. Short-term capital gains, those are investments that are held for less than a year, and they're taxed as ordinary income, which can be as high as 37% currently. Potentially, this could be 39.6% under the new proposal. That's also a decent increase. Lastly, the federal versus state taxes. So it's important to note that these changes apply to federal income tax. So state taxes would be additional, and in high tax states like California, for example. the total capital gains tax could reach as high as, are you ready for this? 59%. These are pretty substantial increases when you look at the current tax code. So I wanted to give you all a practical example, right? Let's put it in terms that we can all understand. So imagine you bought an investment property for $400,000 in 1995, and now it's worth, I don't know, let's say $3 million, right? You hit the location lottery with that. Then you decide, hey, I'm going to sell it. I'd have to pay taxes on $2 million worth of profit, right? Well, under the new proposal, more than half of that profit could be taxed at up to 59% in California, meaning the state and federal government could make more money from the sale than the actual homeowner. That doesn't sound like a great deal if you're the homeowner. What about some of the other proposed changes? Well, there are a lot because it's a 256-page proposal, but I wanted to highlight a few more of the key points. First of all, the top federal income tax rate. The proposal aims to increase the tax rate on incomes over $400,000 from 37%, like I said, to 39.6%. There's also a 25% wealth tax. And that's a 25% wealth tax on assets over $100 million, even on unrealized capital gains. I can't imagine the nightmare that's going to be if you're starting to tax on unrealized capital gains and what that could ultimately result in. But that's what it currently shows. And the last point is the limiting 1031 exchanges. So this new proposal would limit the 1031 exchange to $500,000 per taxpayer. So this would reduce the incentive for property owners to sell and then reinvest in more expensive properties. Because right now that 1031 exchange allows you to essentially take whatever profit that you have, invest it in a similar property, and you don't pay any taxable gains on that. Well, that's going to limit this in the new tax code. Also, one more that I wanted to talk about, stock buybacks. So the proposal includes a 4% tax on stock buybacks. Now, as you know, companies often buy back their own stock to increase share prices, benefiting shareholders. So you're seeing that it distorts the incentives of some companies in order to buy back their stocks. And then you can also talk a little bit about the corporate income tax rate. This is big. The proposed change goes from 21% currently to 28%. So as you can see, there is a lot to this particular proposal. But I wanted to kind of get to the bottom line. So this is the Beavers Wealth Management bottom line. It's important to note that the Tax Cuts and Jobs Act is expiring in 2025. And so this means many of the current tax benefits are set to be eliminated unless a new proposal takes their place. And so while it's unlikely that this exact proposal will pass, we can expect some pretty big changes to the tax code. So the biggest takeaway is that taxes are likely to be higher in the near future. Now, let's talk about some potential changes and implications. And so some of you may know this, but my dad, Matt, we're incredibly fortunate to have him on the team, by the way. But before joining the team, he was a practicing CPA for 30 years. And although he can't prepare tax returns for any of our clients, he helps us ensure that our financial plans and our investment strategies are tax efficient. So what I thought would be fun is I wanted to give you this point through Matt's tax lens, if you will. And so what he kind of looked at is he goes, any increase in taxes will have a significant implication in terms of how we invest, where we invest, and how we structure our financial plans so that we can be tax efficient. So one example of this is something we help our clients with in terms of borrowing against assets, right? And so I wanted to give you an example. So wealthy individuals, they often borrow against investments instead of selling them because loans against assets, they're not taxed, right? So if I have, let's say, $10 million in the stock market and I want to spend $1 million, selling $1 million of the profit would subject me to a 44% tax, right? under this new code of 39.6% capital gains plus 5% net investment tax if Biden's new proposal is passed. Now, however, if I borrow $1 million against my $10 million investment, let's say I'd pay around 6 to 7% in interest in today's dollars or in today's rate environment. This strategy might be more cost effective and timely because the interest you pay could be significantly lower than paying 44% in taxes. So by borrowing against investments, more money remains invested, potentially generating further returns. And this is why we offer our second opinion service. As we know, the ever-changing landscape of maximizing your wealth can get complicated. We're invested in your future, and we're here to support you, and those important to you every step of the way. And so if you'd like to learn more about what we've just covered, or if there's someone dear to you who could benefit as well, we'd be honored to provide guidance. Ensuring you and your loved ones are making smart investment decisions and taking advantage of every opportunity in the market, this is our top priority. So please ask us about our second opinion service. Okay, now for our final point, into the future, we're going to talk about scaling laws for neural language models, or AI. So we've talked a little bit about this in the past, but I think it was very important to discuss because of the recent release of ChatGPT 4.0. We've been seeing firsthand the remarkable advancements in AI and in language models. So for those of you who are wondering, the O in ChatGPT 4.0 stands for omnimodal. So meaning the model can handle multiple types of input and output modalities, such as text, images, audio, and video, making it more versatile and capable of interacting in so many different ways. So here are just a few examples of the new improvements in the capabilities of the latest and greatest AI model from ChatGPT. Now, honestly, I recommend everybody here spend a few minutes to actually watch the OpenAI's latest keynote, where they'll actually show off all of these new capabilities. It truly is mind-blowing. And we've mentioned in previous editions of Let's Talk Markets that AI will be a significant catalyst for markets. Therefore, it's important for us as investors to understand the forces that will shape the future of AI. So we researched the scaling laws for AI, which detail the factors that could hinder this growth and the factors that could accelerate it too. And so I really wanted to figure out what are the ways that one AI is better than the other. And we broke it down into 3 specific ways. So first of all, compute power and infrastructure. The power and infrastructure. The scalability of AI depends a lot on compute power, like having a strong oven for baking. You know, I like my desserts, so I got to bring up something about baking. So as models grow, they need more advanced ovens. This is computational infrastructure. Companies investing in these ovens, like cloud computing platforms and specialized AI hardware, they're going to have an edge. And that's why we've seen Nvidia become the market favorite stock, right? Everybody loves it because they currently make the most powerful processors that power AI. So we should consider how much firms are putting into their computational infrastructure as a key factor in their growth potential. Second, data availability and quality. So AI models, they require data for training, and so the quality of the data is crucial. So I want you to think of data as the ingredients for our cake, right? High quality ingredients make a better cake. I got to give a shout out to my mom on this one right now, because for any of us that are on this call that have had any of the cupcakes or Rice Krispie treats, I want you to know that my mom makes her own vanilla. It takes almost a year to make the vanilla that she puts into each of those desserts. So think about the ingredients here. They're high quality ingredients. That's the same thing that you have to look for when it comes to what AI is better than the other. Companies with access to large, high quality data sets, they're going to have a big advantage. And this means investing in firms that have strong data strategies is going to be so important. So I want you to think of Tesla this way. They're not really an EV manufacturer. They're a data company. Do you know that they're collecting 15 million miles of road data each day? When I found that out, blew my mind. So they really are a data company. Thirdly, regulatory and ethical consideration. So as AI scales up, it's like baking for a big event. You need to follow health and safety rules. And we should be aware of the regulatory landscape and how companies handle these challenges. So what about Beavers Wealth Management? What's our investment focus here? Obviously, leading AI innovators. You want to invest in companies that are pushing the boundaries of AI innovation, especially those focusing on large-scale models and efficient training methods. These firms are likely to set the standards for future AI capabilities. Other companies, infrastructure and computing firms. So firms that specialize in cloud computing, AI hardware, and data centers will be crucial in supporting the growth of large language models. So companies that provide the backbone for AI development. I want you to think of, during the gold rush, all the companies that were selling the shovels, they're the ones who really made money. They were the backbone, and we need to look for those companies that will be that backbone for AI development. And then, of course, data-driven enterprises. This is the key. We should prioritize investments in companies with strong data assets. The ability to manage and utilize high-quality data will be a significant differentiator in the AI market, because data is the new gold. And then, of course, we can look at ethical and regulatory leaders as well in the market. These are the firms that are better positioned to handle the complexities of the evolving AI landscape and really sustain long-term growth. The advancements in large language models like ChatGPT 4o, they show us the incredible potential of AI. Focusing on model size, computing efficiency, data quality, and regulatory compliance, these will be key to smart investment decisions in AI. And it's honestly going to determine who are going to be the winners in this AI race. Okay, a lot of information that we covered. So in conclusion, let's break it down. What did we cover today? Once again, we recapped the past month of May, examining what's been happening in the markets. Then we took a look at the present. We discussed the proposed changes to the current tax code. And finally, we looked ahead to the future, investing in AI, what factors are in play in determining which companies will come out on top. Hey, the last thing on AI, did you hear about the printers that learned to play musical instruments? You want to know what their band name was? Paper Jam. All right, we appreciate you joining us today, and we are truly grateful for each and every one of you. If you enjoyed today's content, we have all of our replays of Let's Talk Markets posted on our website and the podcast format on Spotify. So please feel free to share with anyone you know who may find this valuable. Thanks again for tuning in, and we really look forward to seeing you in June on our next installment of Let's Talk Markets. And don't forget, leave it to Beavers.